Having a structured process for how you do your financial planning can help avoid making an impulsive decision or mistake in how you manage your finances. How can this be? Well, if you have a plan and you evaluate the consequences of each action from an investment standpoint or a tax standpoint or many other factors, both long and short term, before making any decision or action, you're much less likely to make a mistake or rush to a judgment too quickly. Many people imagine great financial advice as just brainstorming these great ideas. The reality is far more nuanced and personalized. What constitutes a great idea for one person may not be a good decision for another. Effective financial advice isn't about getting that flashy, high risk bet. It's about carefully constructed process that considers each unique situation, circumstance, and goal to help generate that sound set of ideas that fit uniquely into each person's plan and what they're trying to accomplish. So let's dive into the steps involved with generating a consistent high level recommendation set for clients. This is what I do on a very high level. And you can leverage this by better understanding how to expect to work with a financial advisor. If you want to do things on your own, you can use this as a starting point for building your own framework for financial planning. By far, the biggest mistake that I see is people think that they have a financial plan, but they may be working with a plan or an advisor that has an incomplete picture and specializes only in one area without a comprehensive scope of all areas that are impacted by recommendations. Obviously, everyone has limits to their knowledge, but clients should be getting a plan that includes tax planning, cash flow planning, investment planning, insurance planning, employee benefit planning if they're working, or retirement income planning if they're retired. And there should be a high level of support with estate planning matters too, even if the advisor isn't providing legal or tax advice specifically. These are the critical components of the certified financial planner curriculum. And clients should know there are limits to every relationship, but also what to expect from their advisor, who may be facilitating conversations with other professionals in these areas. Today, I'm going to break down my process and how I help people and work through steps to create planning guidance across these key areas and give you an insider perspective on what the process of financial planning really looks like. The first step is understanding your unique financial landscape. It's the foundation really for sound advice. This involves more than just knowing income and expenses. It's about building a comprehensive picture of your financial health. This initial phase includes gathering detailed information on the following: income and expenses, a detailed breakdown of your income streams now from your salary to any investments and projected future income, whether that's Social Security or pensions, and projecting household expenses. This is crucial. It helps determine your cash flow and your spending habits, and understanding where your money goes is the first step to managing it effectively. Then we got to get a picture of your balance sheet. And this is understanding your assets as well as your liabilities, almost as if you were a corporation in your household. It includes everything you own, from your house to retirement accounts, investments, any cash values and insurance or annuities, and everything you owe, which includes mortgages, loans, credit cards, debt. This provides a clear picture of what your net worth is, which is a critical aspect of your overall financial position. Then we take a snapshot of where you'd like to go. Money's only as good as what it buys you. And otherwise, it's just a number on a screen. So, what are you saving for? Is it retirement? Is it freedom to be financially independent? Is there other important milestones that are important to you? A down payment on a house, a child's education. Clearly defined goals help provide direction and prioritize investment strategies and financial planning strategies accordingly. Short term and long term goals need to be considered separately. Then we take a picture of your risk tolerance. How comfortable are you with market volatility and the possibility that you might lose money? This is a crucial factor in determining the appropriate investment strategy for your situation. Some people are more risk averse and prefer safer, lower risk investments, while others are more comfortable with higher risk, higher return options. It's not a static number. It can change over time based on your life circumstances, and this will help you determine how much investment returns you can comfortably assume in your plan. And this will also help us determine how you might manage shortage in your projected success. Are you comfortable not trending to a high percentage of success? Or if you're addressing a shortage, do you want to take more risk? This may make sense, but only if you can tolerate higher volatility. Then, and lastly, we need to determine your time horizon. How long is it until you need this money? This significantly impacts your investment choices. If you have a longer time horizon, that means there's a longer time period when money can work for you and can allow for potential greater risk taking, while shorter time horizons may necessitate a more conservative approach. We create a detailed assessment which forms a bedrock upon which subsequent advice is built. It's not a one time process, but an ongoing conversation that adapts to changing circumstances, and regular reviews of your cash flows, goals, and balance sheet are important to ensure your plan remains aligned with your evolving needs. What's crucial in our process is that we also aim to provide life planning. This includes questions that push you to really consider what's important in life and ensure our clients are maximizing their resources to lead the most fulfilling life possible, both now and in the future. One question that we use that helps break down what's important for people is, what would you do if you only had 5 years left to live? This question creates an artificial scarcity. It can at times break the normal thinking pattern and push us to think about what's really important in life. Ignoring this crucial step of understanding your financial landscape can lead to poorly aligned strategies and suboptimal outcomes. The more detail you provide, the more accurate advice will be that you get. After we capture this understanding of your financial positions and accounts and all of that, we then need to go deeper and define your financial goals more specifically. This is really setting the course of where we'd like to go in the future. With a clear understanding of your financial situation, the next step is to define your financial goals more specifically. This involves more than just general aspirations. It requires setting goals that are specific and measurable and relevant and time bound. If you want to retire, we need to really understand how much you need to spend every month, when you need to retire, what's the capital amount that we're going to need to save in order to spend that amount continually. For example, instead of saying, I want to retire comfortably, we need to create parameters around this goal, which could look like, I want to have $2 million in retirement savings by the age of 65 so that I can supplement my Social Security by $6,000 per month of portfolio distributions. This step involves defining concrete targets to work towards. This process involves prioritizing goals. Not all goals are created equal. Some goals are more important than others, and prioritizing them helps allocate resources more effectively. This might involve ranking goals based on how essential they are, or whether they're more important, or whether they're more aspirational. Then setting timeframes. When is the realistic time frame for achieving this goal? This determines the appropriate investments that we might take and the level of risk that we can take in pursuing that goal. Then we need to consider other life events that may interrelate. Major events such as marriage, having a child, buying a house can significantly impact your ecosystem of financial goals. These events might be factored into the planning process. Unexpected events is also a factor, such as being prepared for an unexpected job loss or something along those lines. From there, we need to regularly review and adjust these goals. It's a dynamic process that can change over time as your priorities in life change. Regularly reviewing and adjusting your goals as life changes is essential to ensure your financial plan remains relevant and effective. This is an iterative process, so you don't want to hesitate about making a planned goal, because you can and should change that in the future as your priorities change. But creating these goals is essential to an effective planning process. I often tell my clients that working with their advisor is like, I'm like their financial GPS. You tell me the destination, I tell you what's the most effective strategy and direction to get there. Without a clearly defined destination, your efforts may be scattered or potentially unproductive or even counterproductive. The specificity of your goal directly influences the recommendations that you receive. After we do this, this is usually the first step. And it may be one meeting or two meetings with someone where we're really going through that discovery process and fleshing out what those goals are. After that is the analysis step. And this is where, as an advisor, I take a step aside, taking into consideration all the most important information that I got from that first meeting. And we conduct this analysis to bridge between gathering information and reviewing projections. This step involves creating an analysis that projects your current financial situations out to the future, evaluating the viability of achieving your goals. And this is where rubber meets the road in the financial planning process, translating some of these aspirations in the future into real action steps today. We use a financial planning software called Right Capital that helps us to create a living, breathing model of what that client's life and future will look like. But it can also be done with an old fashioned yellow pad of paper and calculator. This crucial step involves a few components. So financial projections and forecasting, where we're constructing detailed projections about future income, expenses, and asset growth based on various assumptions, such as inflation, investment returns, and projected salary increases. These projections paint a picture of your life and what it's likely to look like in the future, highlighting potential areas of strength and weakness. Multiple scenarios may often be modeled to account for some of the uncertainty and risk with the future. We also conduct a goal viability assessment. By comparing your projected financial resources against stated goals, we assess the viability that you're going to achieve them, and it may reveal a shortfall in your resources, requiring adjustments in your strategy. This isn't necessarily a negative thing. In fact, usually it's great because it's an opportunity to adjust areas or maybe goals to improve and refine your plan. We can conduct a trade off analysis. And if that shortfall is identified, we can diagnose the root cause of that shortfall and explore what combination or potential trade offs might address this to be on track with our goals. This might involve adjusting savings rates, altering investment strategies to target higher returns while acknowledging higher risk, or adjusting or delaying certain goals, or working longer, or perhaps even having a part time job in retirement. The specific trade offs are unique to each person's individual circumstances, tolerance, and priorities. This is a collaborative process. So we discuss the shortage and we propose possible solutions that may be viable to determine what's best for each situation. Then we're going to analyze multiple different financial areas. Once we have the forecast, we can review how the investment allocations impact the forecast, what tax positions we have currently, and what are the future tax rates, current estate planning implications for the setup, and stress tests for different possible scenarios in the future. We evaluate which set of recommendations we feel enhance the situation for the client and enhance their probability of success without a whole lot of heavy lifting on the client's end whenever possible. The goal is to run a couple of scenarios and determine which set of recommendations achieves the best forecast, considering the client's unique risk tolerance parameters, needs, and personal factors. Then we decide which scenarios of the possible strategy are the best to share with the client. It's a dynamic process, regularly reviewing and adjusting to reflect changing circumstances and new information. So while we may move on to step three and present these solutions, we may take a step back before proceeding and really explore with the client what they think is best. We repeatedly revisit this analysis every time we do a review meeting so that we can monitor their progress and changes in their funding status. And the goal is to really create a plan that's not only viable, but also an ongoing process that's resilient and adaptable to life's unexpected turns. Step three is where we're developing that personalized financial strategy. Once your goals are understood, your financial situation modeled, a personalized financial roadmap can then be developed. This involves selecting appropriate investment vehicles, determining the correct asset allocation, and risk management techniques. This phase involves first determining your asset allocation. There's actually Nobel Prize winning research that suggests 80 to 90% of your actual lifetime investment success is determined by your asset allocation. So it may be one of the most significant financial decisions that you make in your lifetime is the percentage of stocks to bonds and other asset classes that compose your portfolio. While stocks have the highest potential, a considerable amount of volatility that goes with that. And the appropriate mix of assets in your portfolio will be determined by your unique financial plan and investor profile. While asset allocation is paramount, diversification is key to mitigating risk. Within each asset class, there should be different types of stocks and different types of bonds and so forth to make sure there's not over concentration in one area or sector. Then we make investment selections. Within each asset class, we have to actually pick an investment vehicle to get that investment potential and capture that potential. This requires careful consideration of factors such as overall portfolio philosophy, risk, returns, fees that third parties may incur, liquidity of investment products, and due diligence on certain investment process from different companies. This selection process should align with your overall financial strategy and risk tolerance. Then we conduct risk management assessment. This involves identifying mitigating potential risks in your financial plan. This includes diversification, insurance, and risk management is a crucial aspect to protecting your long-term wealth and the long-term success of your financial plan. For those closer to retirement, risk management may be a greater focus on general liability protection, maybe looking at if your liability in your insurance is enough or if you might need an umbrella policy. You may also need to start thinking about long-term care needs and how that potential cost may factor into your plan. Or for people younger in their career, they may be greater focused on the risks of disability or life insurance risk. Beyond that, it's wise to reevaluate insurance on an ongoing basis to make sure your protections are sufficient to what your needs are. And then we do cash flow planning. We determine minimum hurdles in terms of savings needed to achieve and reach your goals. And for people that have bonus or stock compensation as part of their plan, this is a critical part where we can help determine what is the best routine every year to put and manage incoming funds to work for their financial plan. It can also help to determine how much or too little is needed in an emergency fund or checking account and how we can adjust and put certain excess funds to work when necessary. Then we do tax optimization recommendations. This involves structuring your investments and financial transactions in a way that minimizes your tax liability. Tax optimization can impact and enhance your overall returns. This often requires specialized knowledge and expertise. We usually evaluate the life cycle of your tax profile and determine what recommendations are going to lead to the lowest lifetime taxes, not necessarily just the lowest taxes this year, without sacrificing investment returns. This involves investment product optimization, but also determining appropriate savings vehicles. All recommendations should be supported by documented projections, such as whether Roth conversions make sense or not this year. What are the assumptions we're using, and how are we showing our projections and our reasoning behind that? Or if pre tax contributions should be maxed out over Roth, why is that? What are the tax implications that we're really aiming to achieve with that decision? And then estate planning is a critical part. This involves planning the distribution of your assets after your death, including having a will, setting up trusts, and setting up other estate planning vehicles, such as having beneficiaries or retitling accounts and property where possible. It's crucial to ensuring assets are distributed according to your wishes. Recommendations should be discussed if the current setup does not appear to match the client's desires, or if an attorney is required for certain legal advice or documentation as a part of implementing a plan. So the strategy should really be developed and tailored to your specific circumstances and goals. All of these different areas may be different in each individual. So it's not a one size fits all approach. The process should be transparent and easily understood, allowing you to actively participate in the decision making and understanding the pros and cons of certain recommendations in the decision making process. Once we have a plan, it doesn't stop there. Then we begin the implementing and monitoring the financial plan. It's the ongoing journey. Implementing your financial plan involves taking concrete actions to put the strategy into effect. This may involve opening new accounts, making investments, obtaining or canceling life insurance or other insurance policies, meeting with other professionals, or even adjusting your personal spending habits to get on track. This phase typically starts with account setup. It involves opening necessary accounts to implement an investment strategy. For clients that we work with, we'll usually assist them in that process. It includes maybe brokerage accounts or retirement accounts or investment vehicles. Could include rollovers from old accounts or consolidating multiple accounts under one custodian. Then, once that's done, we facilitate investment execution. This involves making the actual investment decisions and placing the orders in your asset allocation strategy. It involves buying stocks, bonds, or other assets or funds to get the exposures that we need. Regular monitoring, reviewing your financial outlook as markets and life changes and making adjustments as needed. This ensures that your investments and your planning are continually aligned with your risk tolerance and goals. Periodically, we're also going to want to rebalance. It involves periodically adjusting your portfolio to maintain your desired mix of assets. This helps to mitigate risk and ensure your portfolio remains balanced. Then there's tax management. This involves ongoing projection of your taxes throughout the year, considering options to minimize your tax liability. This may involve tax loss harvesting or other tax saving strategies such as Roth conversions or IRA contributions. Implementing and monitoring your plan is an ongoing process. A plan is absolutely worthless without action. This is one of the areas where working with an advisor can be tremendously beneficial. An advisor will help you sort through all the previous steps and use this experience to identify what's unique about your situation and what actions are potentially the most crucial to support your success in your financial plan. Regular reviews and adjustments are essential so that your plan remains effective and aligned with your evolving needs and goals. It's not a set it and forget it process. It requires active participation and ongoing attention. So when do you consult with working an advisor? When does that make sense? Well, the steps outlined above can be applied independently. Seeking professional guidance from a qualified advisor can be invaluable. An advisor brings expertise, objectivity, and a broader perspective to the process. Consider consulting a financial advisor if you lack the time or expertise. Managing your finances effectively can be time consuming and complex. An advisor can free up that time and provide a high level of knowledge and guidance. Or if you need objective advice, it can be difficult to be objective about your own finances. There's a lot of money tied up with money, and an advisor can help you make informed decisions along the way that are sensible and rational. Or if you're facing a complex financial situation, if you've received an inheritance or have recently gone through a divorce, or you're working through a complex set of executive compensation packages, an advisor can navigate these challenges. You want a personalized plan. A financial advisor can also help you create a custom plan for your unique goals and situation. This ensures your investments are aligned with your overall financial objectives. Or if you feel like you really would benefit from the ongoing support and monitoring, an advisor can provide that accountability and that ongoing support and communication to ensure actions get done and that your plan remains effective and addresses your long-term goals. A financial advisor acts as a partner in your financial journey, providing guidance and support every step along the way. And they can help you navigate complexities of financial planning and make informed decisions that align with your goals. By understanding this process, you can either manage your finances effectively or work collaboratively with an advisor. Remember, sound advice is not about quick riches. It's about defining your situation and making rational decisions along the way, and hopefully getting a lot further along than you would have otherwise. If you found this video helpful, please check out the video in the description below financial strategies that can help boost your bottom line nest egg for retirement by potentially 100,000, 200,000, or more, and follow along for more financial adventures.